Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. It is Wednesday. I'm late again. You know, what keeps happening is I keep having like networking problems and then my lights don't turn on. I'm trying to fix all that. Plus, I'm taking longer to get ready. So I need to fix that. But that said, we don't have too much going on here at the very beginning. We did just have some news. Building permits came in. Housing starts and building permits slightly under expectation. Let's see, building permits change month over month, negative 3.7 versus an expected spot 2. U.S. housing starts change month over month, negative 8 versus an expected negative 9.3. But not too much of a change from it. Let's just come over here into the charts. So we continue to be in a pretty tough spot in the treasuries where we just are like inside this range. There was some pretty, like after we left, there was pretty consistent selling. But then you can see in the overnight, they bounced back up. We're actually heading on the upside. There was some European, actually, I think it was UK inflation data that was good. So that may be why we're moving up here in the treasury. Then we got the S&P 500. You can see pretty dead overnight, but some big jumps. And remember that the equity indexes are kind of acting bizarre right now because they are doing a rebalance in the NASDAQ on Friday. Oil kind of bounced a little bit yesterday, but 76. So kind of middling. Here you got gold, hasn't done too much. Silver still kind of on a slight upside bias here, and copper still kind of struggling. So China, I mean, this is the big thing is a lot of the growth in markets and a lot of the stuff that's moved markets in the past was China. And with them not really moving, that like really changes things and it kind of makes it a little bit difficult sometimes to sort out what's going. Bitcoin, meanwhile, falling below 30,000. And there continues to be a lack of activity over there. And the dollar kind of on the upswing here a little bit. As the UK inflation data comes down, that means lower interest rates and less money going over to the UK, and thus a stronger dollar. Not quite to 100, but pretty darn close right now, 99.87. So that is where we are at. And ergo, I'm not so sure if I have a strong bias as to which way this is going to go today. I am seeing some, in the volume, I am seeing some steepening. It's also kind of a little interesting to be back at 3.735, like below 7.5, in fact. Relatively high here in the treasuries. Rates relatively low and the treasuries relatively high. Okay, so first thing that we've got to do today is we need to look at good old Goldman Sachs's results. They should have reported, yeah? Carvana shares soared a 14th month high on debt restructuring plan. Well, they don't have a story on Zero Hedge yet. Let's go to CNBC. Okay. Goldman Sachs reports 3.08 per share versus the estimate of 3.18, and a revenue of 10.9 versus 10.84 billion. So revenue higher. Wait, how is the revenue is higher? So there was some costs. I see. Second quarter profit fell 58% to 1.22 billion, or 3.08 a share, on steep declines in trading and investment banking, and losses related to Green Sky and real estate, which sapped about 3.95 from per share earnings. Company-wide revenue fell 8% to 10.9 billion. So this is all really interesting because these results are not really very good, but they are not for any of the reasons that I would have thought. So even more different problems. Company disclosed a 504 million impairment tied to Green Sky and a 485 million in real estate write-downs. Ouch. Goldman shares dipped less than 1% in pre-market trading. David Solomon faces a tough environment for his most important businesses as slump in investment banking and trading activity drags on. On top of that, Goldman had warned investors of write-downs on commercial real estate and impairments tied to its planned sale of fintech unit Green Sky. Unlike more diversified rivals, Goldman gets the majority of its revenue from volatile Wall Street activities, including trading and investment banking that can lead to outsized returns during boom times and underperformance when markets don't cooperate. Because volatility has been low in equities, at least. In equities, it has been low. Wow, bank put up a paltry 4.4% return on average tangible common shareholder equity in the quarter, a key performance metric that's far below its own target of at least 15%, and its competitors, including JP Morgan and Morgan Stanley. See, yeah. Rival JP Morgan Chase posted better than expected trading and banking results last week, saying that activity improved late in the quarter and that raised hopes that Goldman might exceed expectations. But fixed income trading revenue fell 26% to 2.71 billion, just under the 2.78 billion estimate of analysts surveyed by FactSet. Well, it's because I'm not working there. That's what, no, just kidding. Hey, good morning, Alan. Yeah, the impact on the share price hasn't been too terrible, but I continue to look at Goldman and feel like there's something else going on over there that I'm not seeing. Well, despite there being a pretty okay trend starting from all the way down here at 29, we seem to have peaked, at least temporarily, pulling back from 05 back to 02. I am seeing the selling is a lot stronger in the ZB, and so again, I am getting like steepening behavior, although it's a little curious. The 10-year seems to be lagging here today. So let's come over here, check out Mohammed A. L. Arian. The technicals are favorable because people that have stayed out of this market are now getting pulled in by a very strong soft landing narrative. They bring people in across the board and out of short-term cash. I don't expect this to change anytime soon. That's very interesting. So we're getting something really unique in this market that is kind of causing me a little bit of trouble trying to sort out. So the overall like global liquidity, like central banks printing money, putting money into the system, taking money out of the system, right? Overall, they're taking money out of the system. And it's a pretty quick pace as well. So you would expect equity markets to be down. And of course, we have had some like foibles this year. But then when the economic data comes in, we get this confusing spot where it's like the leading indicators and so forth all seem to look bad. But then when the more trailing indicators that are kind of more important in terms of like what is actually going on tend to say, oh, it's okay, and we're going to have a soft landing. And so you got all of these people in the markets that are getting pulled into this market, right? So we're seeing like strong gains in the equity markets from like short covering, even though we're having the money pulled out of the markets. So then this kind of makes you wonder about the inflation thing again, right? Because if so much, even if we're taking the money out of the markets are able to rise because of these other things, then doesn't that suggest that inflation could come back really hard? Michael, hey, welcome to the stream. Could you give a quick explanation of your ES DOM setup? Well, so I don't have my DOM setup too unusual, except for that Jigsaw has a feature called tick aggregation. So I aggregate every four ticks, so you can see I'm only showing like full points, and then it kind of combines all of the level 2 and volume together from those 4 ticks. And then other than that, it's the standard Jigsaw DOM. Blue column is bids, orange red column is offers, and then the 2 columns in between that are market orders hitting into it. And the current trades column, that's what they call them, the 2 columns in the middle, has a feature where if it ticks up and there's kind of like a reset window. So if it's been more than 2.5 seconds, I think it is, and then it ticks back down, it will reset that current number of contracts down there. That way you can see how many contracts it takes to clear it every time. And then you just got on the far left, you've got the volume profile. So I don't actively trade ES anymore, but we do have to keep track of it with our, we're trading our treasuries and so forth. So that's a really good way. Having that tick aggregation allows me to get a good high level view of things. I'm just kind of going down through my feeds and so forth, seeing if there's anything overnight that... Oh, you use Sierra? Well, if you go into our Discord, there is a platforms and brokers forum, and they have a thread there about Sierra charts that has where Octavius has posted a template or two. Or you could just ask Octavius, and he has some templates to get your... Because, setting your DOM up correctly in Sierra charts can be kind of confusing. How do you get it to look the way that you want, It looks like another thing I'm seeing here is equity flows have turned in favor of the US versus other countries. It's kind of curious. Usually it's as simple as, is the Federal Reserve taking money out of the market or putting it into the market, right? We should be selling. it does kind of make me, I am really concerned that a sell-off is in our future, right? You get all of that money on the sidelines to come in, and then, you know, once you get that out of the way, who's left to buy? And then you could see some selling again. So far, it hasn't happened because everybody keeps fighting it. Nobody believes. Nobody believes. The keyboard devil is after you. What? I haven't heard of the keyboard devil. You can easily replicate. I mean, you can definitely replicate it, but I think to new users, it's really unclear. To new users, it's really unclear where the settings are and which settings you need to change. Oh, he lives here at the house. Is the keyboard devil? Is the keyboard devil a cat? Oh man. Jeez, yeah, yesterday, so my wife wants to get a new couch because there's not enough seating in the upstairs room. And I was like, or you could get a tropical fish tank, you know, because it was about the same price. Not a tropical, a saltwater fish tank, because she used to do saltwater fish and loved that. But she just, I don't know, she doesn't really have the time and don't have very many good places to put it. But we could make it fit. But she's like, no, what I really want is another dog. We already have a dog, but she doesn't like that dog for some reason. I love it, but she's not, she wants another dog. But I don't want to get another dog. I have enough problems with the one dog. And the two babies. It's a handful. It's a handful. But then I'm like, well, let's not get a dog. Let's get a cat. Let's get one of those hairless. I want a hairless cat. Listen, I know they look stupid. Okay, they are so cool. They're like, there's no cat like it. There's no cat like it. But I don't know. Maybe I'm not a cat person. Think I'm too successful to be a cat person. Ugh. What is going to happen when we have all of these old ladies that are like in their 70s, never married, and have nothing but cats? Gonna be a weird world. Old folks' home won't be able to handle it. That is, if they're able to go into the old folks' home. Do you think? So, I'm concerned. See, I'm being like so ADHD right now, but I can talk about whatever I want right now. There's nothing super serious going on, right? I'm concerned that not just baby boomers, but in particular your Generation X people are not properly prepared for retirement. They're not putting money away in their 401k. You know, to me, it's like mind-boggling. Like, how can you not be saving? But I guess not everybody has been taught that you need to max out your employer's 401k match and all that stuff. Listen, if you are working a job where you have a 401k and you are not contributing to it, and in particular maxing out your employer match, which is usually around 4%, but some of them have weird setups, right? You need to get on that. You need to get on that. You cannot afford to not be contributing. That's like free money that you're just throwing down the toilet. You're just like, oh, I don't actually want the free money. And yeah, you can't afford it, because if you can't afford it in your budget right now, you're definitely not going to be able to afford it when you don't have very good options on income in your 70s and 80s. Well, they're kind of pushing the bottom end of this range again. You think they're going to come all the way back to 29? When this started, I was kind of, I was like, the volume seemed a little iffy. It was mostly selling in the 30. Now they all seem to be coming along. Most live paycheck to paycheck. Well, you should be living paycheck to paycheck, to be frank with you, Lafta. So if you are not living paycheck to paycheck, that means you are not contributing enough to your retirement accounts. Like you should not have money just sitting in your bank, right? So I think that this polling option that they frequently do that says that most Americans are living paycheck to paycheck, I think is extremely deceptive. Okay. Yeah, there are some people where they make, a certain amount, and everything that they make goes into rent and utilities and food, and that's basically all their money. Okay, that is true. That is not most Americans. Okay, most Americans should be contributing to retirement account and things like that. And like the thing is, you got to realize, you can contribute $22,500 to your 401k a year, right? And if your employer match is, let's say that your employer match is 4%, right? Let's do a little math here. Okay. So if you employer match is 4%, 22,500 divided by 2, because your employer matches half of it, right? Okay. Divided by 0.04. Okay. That means that unless you are making $281,000 a year, you are probably not maxing out your 401k contribution, right? So the reality is for most people, they don't get to a spot where they actually have extra income outside of like what they could be contributing into savings until you get into like $130,000, right? But people think, oh, if I don't have enough money in my bank account to handle an extra months of expenses, then I'm living paycheck to paycheck. And it's just not an accurate picture of what people's financial condition is. Right. But there's lots of problems, right? A lot of people have college debt. Lots of people are having trouble dealing with inflation. That's definitely been me. It's like inflation went up, and then we had a baby, so my wife wasn't working. So we had to shift around our budget a lot. Yeah, I don't know in the EU countries what their options are for retirement. I'm wondering if that's really something that I should get into or not. I mean, like, I could go in and I could read it, but I can tell you what the max contribution is here in the United States, right? 22.5, and then you can also contribute an extra 7,000, unless you make over 140,000 a year. I think then you can still contribute it, but it has to be after tax contributions. It has to be Roth, basically. That's a rule change that is about to go in effect, apparently. I know all those things because I took the Series 65, so I'm like, should I know the Series 65 type of things for like all of the countries? Well, it might help for the stream because a lot of you guys are over in Europe, but probably would be too much to memorize. Here's the thing that bothers me is I think that if you're making, let's say, under 200,000 a year as a couple, that you just shouldn't have to pay capital gain taxes at all. Like, really, the amount of money that we make in tax revenue from capital gains taxes on the middle class is not that much, and it is holding back a large swath of investment. Can you imagine? Can you imagine if you could invest into anything and not have to pay the tax? So you don't need to worry about the 401k or anything like that. Maybe company still gives you a match on an account or something, but you can just have a regular account that puts it into an index fund. And in that same account, you could also trade stocks, you know, and you don't have to, unless you're making over a certain amount per year, right? Now, add on top of that, opening things up so that like it's easier for regular people to get in on our private equity offering. So right now you can invest in a private equity offering, but it's like there's rules. It's like if it's a private placement, then you can only have like 50 retail investors involved in it, and there's all these, and you can't advertise about it, right? There's all these qualifications, which basically means you can only get in on the private equity if like you have a family member or friend that is involved in the company or something like that, right? And then there's this other side where is like they can advertise it and things like that, but you have to be a qualified purchaser, and it has to be like you have to own certain millions of dollars. You know, it's like this high bar that nobody ever meets unless you're like a billionaire, right? And then there's also these lower levels, like in hedge funds, you have to be a qualified client. We opened that up, like, think about the investment that could happen. Now, of course, it would require some big changes to our systems, right? Because if you're doing those private placements, for instance, we need to make sure that regular everyday people have the information that they need to be able to make a wise decision. I think that putting it behind some sort of a paywall, or sorry, an education wall, like you have to pass a test to do it first. I think that would be wise too, right? Which is what they're doing, right? But there's so much investment that you could get that you're not, because the average person does not think about investing in specific companies, right? We're just told put as much money as we can into our 401k and IRA and not worry about it. But if more people were actively investing, it would be such a tremendous thing for so many people. Simple concept of saving money for a rainy day doesn't happen, or at least having 6 months of pay in the bank. Well, no. But this is what I'm saying is that, like, you max out your employer contribution, and then maybe you're contributing a little bit to your IRA. And for most people, that sucks up their whole budget. And then, their discretionary spending, and that's their whole budget, Like the whole living paycheck to paycheck sort of a thing is kind of based on a paradigm that hasn't existed for like 20 years. Smart idea. Well, it's not my idea. Mitt Romney, when he was running for president, that his proposal was that no capital gains taxes unless you make over 200,000. That's where I get it from. I think Donald Trump kind of, like supported the plan, but when he got in office, he forgot about it. He didn't do anything about it. You'd probably never see the Democrats support a plan like that because Democrats don't want you to invest in money. They want you to stay poor. I don't know. I just, the whole financial system in the United States kind of rubs me the wrong way because it's basically all based on you're too stupid, you should let Wall Street manage it for you. And then all that does is just give all of the money to Wall Street. I think that the more people you have involved in investing, the better off the society is as a whole. And when I say involved in investing, I mean like making active decisions about which companies they want to put their money into and stuff like that, right? So instead, we have a very small group of people making all of the decisions, and they don't always necessarily make good decisions. Because, again, the market's not efficient, right? My argument is that the market will never be efficient, but it would be a lot better the more people that are involved. Well, treasuries have had a hard time pushing new lows there. They've gotten stuck at 31.5 for, it's been a while now. It's been about, when did this start? Yeah, it's been about almost 15 minutes. Who wants to do tithing? Max tithing? Well, you do if you contribute X percent of your income to charitable causes. It tends to help you on your taxes and so forth. Yeah, no, the other thing that we always miss out, we always forget to talk about when you're talking about like your investment accounts. So you have to remember, like, there's your 401k and there's your IRA, but then you can also contribute to 529. So if you're maxing those out, you can contribute to 529s if you have kids. So, and you can give each kid $7,500 a year. So, for me, I have 5 kids. That's like $35,000 I could put away tax-free for college education if I wanted to. You can also use your IRA for college education. So max the IRA out first. There's no reason to like contribute to the 529 and not the IRA. But if you're maxing out the IRA, then you can contribute to it of 529. So you really, again, to get to the point where you really have like extra income that you can't put in a tax advantaged account, right? You really got to be making like in the 200,000s. It's the whole point of that discussion. So now you know everything about, not everything, but the basics about investing. I don't know how I feel about this market. I kind of suspect that it's going to continue selling. Like, it seemed like yesterday that there was, flows. They waited. They waited until after the most active hours, but it was like there's selling out there, Yeah, I really have 5. Well, I have 3 step kids and 2 full-time kids. So we'll put it that way. And the step kids are gone from like Thursday to Sunday morning. So, but overall 5 kids. Yes. Man, I was thinking about that yesterday because my TikTok likes to show me all sorts of divisive stuff, particularly in regards to gender. Like, it really is like, man, social media just wants you to be divided on things, and it will try and zero in on whatever it is that will get you going and show you a lot of that. So it will always be showing me these podcast clips where, like, you know, there's these guys and they're telling these girls why they're so dumb that they're not married and so forth yet. Oh, I'm not really a huge fan of them, but you know, there was you can tell that like it gets me, right? And there's these girls that were talking about like, oh, you know, I'm like doing well, I'm making the money, I'm getting it, and it's like, oh, okay, yeah. Like, you're trying to give yourself a pat on the back, like, oh, you see, I'm better than you because I did all of this stuff on my own. And that's like, well, yeah, I did all of that stuff and I had 5 kids. So, you know, I don't understand what people are doing with their lives when you're like to 35 and you haven't had kids yet. Because I wasn't able to have kids until I was basically like 30, 35. And it drove me nuts. There was, you know, I knew it was like, I have all of this free time to do all of these things. And really I should be having kids. Like, you know, and I did all sorts of types of work to do it. But a lot of these people, it's like, yeah, my hobbies are watching Netflix and so forth. This is like, oh my gosh, guys, you're 35. No kids, and your hobby is watching Netflix? What? What are you doing with your life? Huh? Pick up a real hobby like day trading. Day trading, probably not the best hobby for you to pick up, but college per child is $100K. No, it's not. I mean, it depends on where you go. Okay, if I sent my kids to the local state college, it wouldn't be 100,000. I think it's more like 7 times 4. It's more like 30,000 right now. You do get good tax breaks for having kids, though. Right now, at least. Oh my gosh. Did you see the one? So during the pandemic, they did this thing where like they would give you monthly payments back for each kid that you had. I hated that. I couldn't stand it. Every time I know this is like the dumbest first world problem ever. But every time that money came into the account, it pissed me off. I was like, I don't want your money. I don't want the government's money. I mean, I guess overall I was still paying taxes, but it was like, you know, it's like you're just giving me my own money back. Screw you. I drove me nuts. And then, you know, it enabled more spending and caused inflation. I knew it was coming. Going back, it was from day one. Like when we started, when it was like the Federal Reserve dumped tons of money into the market, right? And then we had like the first rescue bill, and it was like $1 billion. And we're like, whoa, okay, that's crazy. That's a crazy number. Hey, that was the first time that it was $1 trillion or whatever, and we're like, okay. I've never heard that number in government discussions about like a single bill before, right? And then they passed like 2 or 3 more $1 trillion bills and stuff. And I was like, yeah, you're going to get inflation. Like we knew the whole time. And just every step of the way, it made my blood boil. Because I knew what the costs were going to be. And mind you, it doesn't necessarily make my blood boil because of the costs to me. I mean, I had to deal with it for a little while, but I'm in a pretty high demand industry with pretty high demand skills. And I know a lot about finance. So my ability to deal with the inflation and so forth is pretty good. And in fact, I was banking on that over the next 10 years that there would continue to be 2% inflation, and I made financial decisions based off of that. And then the inflation was like way higher than it was, and so like I kind of end up ahead of where I thought it would be, right? But I know that that's not most people, and that's what makes me mad. Because most people just get screwed and never recover. So they don't have the real ability to really negotiate their salary and get those increases and keep up with the inflation. If I send my child to the cheap schools, they develop an accent that spells scumbag. Okay, so we have come back down now to right about where the last swing low was. That's not the lows of the day. You still got to get to like, well, the low of the day is 22. Okay, so there's still a long ways down there to retrace the overnight move. And something that I think we need to be cognizant of is we've had this market lately that like it will sell at the beginning, right? And then around about this time, actually, it'll reverse and it'll be just nothing but buy. So I have no reason to believe that flow will be there today. It's just a flow that I know has happened a lot recently. Okay. And given that we're still quite a ways away from the lows, there's a good chance that one comes in. I guess though, on flow wise, if the money is coming out of the markets, we don't really have. Let me come back over here real quick. Yeah, today we got oil. We do. We have a 20-year bond auction today. So anytime that there's an auction, I'm kind of a little bit concerned about what kind of flows you might see, because those auctions not having strong demand, that's where you can really see interest rates start to rise again, right? I guess we have been moving enough for me to have taken trades and made money. Although I must say, like, it's a pretty decent trend when you really zoom out, but it's been a really tight one, like they go back and forth across that 30 a bunch of times before they finally succumb and go a little bit lower. So that could be a meta order. The thing is that the flows in the treasury are still not enough for me to see. Like, look at this. So at first, I thought, okay, everything's turning down now, right? And then we hit this wall, and ever since then, it's actually been a buy. At least volume-wise, that they've been buying. That's not the case over here in the 30-year. Right? In the 30-year, they continued to sell. In the 5-year, most recently, they've had a little bit of a sell. Okay? So what I'm getting from the volume is a little iffy. Former NASA astronaut claims aliens prevented nuclear war. Man, I haven't thought about the alien thing in a long time. Not a long time. It's been like 2 weeks, right? It's been like 2 weeks. It's so crazy. Like, we'll come in and we'll get like this earth-shattering kind of like piece of news that's like, well, never had anybody in such a high position say things like that. Maybe there really is something going on. It seems like the probability of there being aliens and the government hiding it and so forth like increase every day. but we never get anything conclusive, right? And then there's all the people that say it's all a conspiracy theory. The government wants us to believe in aliens so that we don't like we don't catch on to some of their secret programs that they're doing and stuff. I don't know. Like, here's the thing, okay? We developed nuclear weapons, okay, like in the 40s and 50s, okay? It's been, what, 70 years? Something like that? Since we've had, since nuclear technology came along, right? What kind of technologies have they been developing in the meantime? And the United States hasn't been in a large enough of a conflict to use any kind of like a super weapon like that, right? So surely there's got to be all sorts of crazy things, technologies that they've developed that just like exceed anything we could imagine. There's got to be at least one piece of tech out there that's like, it's like super sci-fi that we don't know about. And yeah, could that include like these drones that like float on their own and do all this crazy stuff? And like maybe China has them now too, and that's why we're getting all these reports of them all over the place? Could be, or could be aliens. Could be aliens. It's more likely that nations are technologically impotent, and that's why posturing is so important. Well, I think that posturing is important because those things have serious costs, right? I mean, the military-industrial complex, and don't get me wrong, like I don't want this to turn into a conspiracy theory thing, okay? Like, the military-industrial complex in the United States is a real thing. I don't think that it has nearly as much power and control as people think it does. We don't live in a true military-industrial complex state. Okay, those do exist. But it's still pretty powerful. It's still a pretty powerful force, right? And it makes money. And it does help the economy, right? But you know, when you're talking about billions of dollars into the federal budget and things like that, you know, you don't really want to have to use it full out, right? You want to have just enough of a conflict, just enough people dying to keep the industry afloat and flourishing, but not enough that, like, you know, like it's World War II where you have to completely readjust your economy for war, you know? So posturing is important. And, you know, it's another one of those things where, again, I think that the best model to use for determining, you know, what people are going to do and so forth is to look at incentives rather than ideology and so forth. Especially in Western countries, because people usually act in accordance with their incentives. That's why I get back into this like Ukraine war thing, right? When we're having this Ukraine war argument, I think everybody's trying to make an argument about whether it's moral or not, or something to that extent, right? And that's not the argument that I'm making. The argument that I'm making is follow the incentives, look at the way that the system works. The United States has every incentive to push back against Russia, right? And so much so that it's kind of foolish for a presidential candidate to stake out such a strong position against it. And you can just go back and look at history. What happens every time, right? The anti-war candidate usually doesn't win. Millions of users abandoned Mark Zuckerberg's latest toy just 2 weeks after the launch. Yeah, so you want to talk about that? This one's kind of funny because when it came out, I was kind of like, oh, look, they're overhyping it, right? Now you're getting the hype cycle the other direction, okay? So it's totally normal for a large company like Facebook to launch a new service and get millions and millions of users come in and try it out at first and then disappear, right? So when they were getting users, everybody was kind of putting those numbers up as, look, this is going to take out Twitter. No, doesn't mean anything. And so vice versa the other way. Losing about half of their active users doesn't mean a thing. Doesn't mean a thing as to how successful that network will be. Okay. So what does matter? Well, kind of, I guess it depends on what the thing that you're interested in, right? So number one for us, the most important thing for us is, will Threads become a news source that we need to start watching? And the answer to that one is no, because you can't use it for that. It doesn't allow you to sort by new. It doesn't have tools that really give you like real-time updates and so forth. That's what Twitter was kind of originally designed around, was to be super lightweight so that it would be effective at transmitting breaking news. And none of those competing services come even close to touching that functionality. Like, they focus on other things. So for us, doesn't matter. Twitter's still the place, that TweetDeck is still the place that we have to watch. And at the end of the month, we're going to have to start paying for TweetDeck, which is an important thing too. Okay. Now, if the question is, will Twitter survive? Will Twitter survive? That's a different and more complicated question. Because Twitter is not getting advertising dollars. So this is a real conundrum, right? Like, if you're a company and you're out there and you go woke, then there's enough people out there that are against some of the things that come with wokeness, particularly when you're starting to push, when you're censoring people for woke reasons, when you are pushing against meritocracy, right? Or you're pushing sexual ideas on children, right? The public doesn't stand up for it and you lose a ton of money. Okay. But then if you go the other way and you try and become a company that is anti-woke, like Twitter has become, then you have all of these companies that are kind of woke or are secretly woke, won't support you and won't put your advertising dollars into you. And so, like, supposedly Twitter is like not making money anymore. Like, they were revenue neutral and they're below revenue neutral now because they're not getting enough advertising, which is kind of odd because apparently advertising on Twitter is like really effective right now because there's not much competition. I'd argue charging people a couple of bucks a month for real-time chronological and self-curated information seems to be worth it. Probably. But it at the same time, it does make me concerned that the overall product isn't going to be as good going into the future, right? Like we really are getting the enshittification of the internet. Basically, the internet was more awesome than was profitably sustainable. Sustainably profitable. Is that what I mean? Yeah. Everything in tech was better than was sustainably profitable. And now that the sources of debt, now that the interest rates are going up and it's not free money all of the time, they kind of have to come back to reality. And so what is the reality? A lot of the websites and stuff that you used don't make enough money and they go away, or they have to change their service. And that's what seems to be happening with Twitter, right? So you put it behind a paywall. Okay, cool. We can still get what we want from Twitter, right? But the problem is, how many less people are going to be tweeting information now because of that, right? So I don't know where it goes. I think that ultimately there's going to have to be another model pop up, right? Hopefully a model that's a little bit more healthy. I know. Maybe the model is and don't get me wrong, because what I'm about to say, you're gonna be like, no, that's not the model. But I think that the model is like OnlyFans, which is to say, platforms that are primarily for creators to connect with and charge their customers, right? A wave of corporate bankruptcies is building. Well, a wave of corporate real estate bankruptcies is building. I don't know how many actual corporations out there will go under because of that. So, I give you a good example. AT&T. We've talked about AT&T here many times, and I've looked at it and I kind of lost interest in it. I looked it up again earlier in the week. And basically the problem with AT&T, yes, it has an insane dividend right now. It's like crazy low. So probably it's oversold, right? But they have a crazy amount of debt. They have a bunch of business problems, like infrastructure that they have to put money into and things like that. They're not really making very much. So that company is not doing so hot, right? Now, is AT&T going to go out of business? No. But that debt is going to weigh on that company's earnings for a long time. And I think that you're probably going to see that in many places where the companies don't go under, but they're not going to grow as fast as they could because of the debt that they put on. Sierra looks neater than Ninja. No. I mean, what do you mean by neater? So, the reality with Sierra charts is by virtue of both the fact that it's written in C++ and that they do not create very much of a framework for you to work off of, it is harder in almost every way to write something in Sierra charts. I don't know why you would say it's more easily customizable. So they're both programming. You can do whatever you want, really. Well, Bob Doan says, if the profitability of internet use is being threatened, aka the elasticity of its demand is increasing, should I not become a software engineer anymore? I'm halfway done with the degree. No, that's not what I'm saying at all. I think that being a software engineer is probably still the easiest place to make money in this current economy. But you are seeing the industry change, right? So a lot less people are going to be working for Google and Apple, right? Not a lot less people, but you know what I mean? Like right now, like the whole computer industry centers around people want to work for Google, Apple, Microsoft, etc., etc. Like those are the top places to work and stuff like that, right? Well, they probably aren't going to be able to afford as many people. They've already let a lot of people go. A lot of those people they didn't need, though. So that does free things up for the smaller companies to do things, right? But the reality is that the needs of the smaller companies are just growing by the day, you know? So like, as an example, the whole AI thing, right? So everybody's like, well, because of AI, you won't even need programmers. Well, that's nonsense, okay? Because where I work right now, AI is just been like another added feature on there that requires even more infrastructure and even, you know, other tools and all of these things. It's just added to the workload. It's just added to the workload. So like, yeah, I think that software engineering will continue to be a strong place. And in fact, I'm even go out on a limb and say something hyper speculative. I don't think that it will ever catch up. So people are saying like, you know, at some point AI will be so strong and so many people will be able to do this sort of stuff that software engineers won't get paid very much, and it will be like an average job, just like everything else in the economy. I don't think that will ever happen. And the reason why is because not everybody can do it. So as long as there is a need for software engineers out there, you will probably have difficulty fulfilling that need, simply because the number of people that are actually, you know, have the minds and the skills to be competent software engineers are few and far between. Most people can't do it. And I really don't, we're not anywhere remotely close to generalized artificial intelligence. So you're still going to need the software engineers, and they might be able to write faster because of the AIs, but you're still going to need them. Oh, thank you, Sebastian. I've been getting more. That's the, you know, I usually don't get a whole lot of donations. Not that, you know, I never ask for it, but that's like the second one this week. So I appreciate it, guys. Do you think that someone has to be at the same level as a hedge fund manager to work at Hindenburg Research? Probably not. I don't really know what kind of... I'm sure that you go into finance and finance research and get hired at a place like that. I don't... That's not something I've ever really looked at a whole lot. You're still the only YouTuber I've ever given. Oh, thank you so much, Uzi. It's so for real, I appreciate it when you guys donate it. It means so much to me. But the fact that you would donate money means so much more to me than like the money. You know what I mean? Because honestly, the YouTube channel, like through the advertising and everything else, makes more money than I would like ever expected or anticipated. So anyways, yeah, I don't know about research outfits. I do know that those people that work in research, that it is a very stressful job. It is a very stressful job. Is, you know, like those people work hard. It's like one of those things that you cannot do that kind of research for very long. You know, like at Goldman in Goldman Investment Research, I think that they said that like you can do that job for like 4 years and then they have to put you out to pasture and put you on something else because it's too much for you to be doing it that long. Unless you get pushed into the management like Jan. and then you have to keep on that grueling work schedule forever. So many tech opportunities, but so many layoffs. Well, yeah, but go back and look at the numbers, because a lot of people did get laid off. Those tech companies laid off a lot of people, but not really a very big change in continuing jobless claims. So almost all of those people, well, not almost, basically what the stats show is that basically all of those people found new jobs, no problem. Right? So the reality was that Google and Facebook and all of these monsters were basically sucking talent away from the rest of the industry that was sorely needed, and we're just wasting them. So maybe that'll result in better productivity, but you know, like, you see what I mean? Where it's like, well, like the number of jobs decreased, but like the opportunities really didn't. So software is still a good place to be. I went to the University of Utah. They have a good computer science program too. I don't know. I kind of wonder sometimes, would I have been able to become as competent of a software engineer without having gone to school for it? I don't know, because it was not anything that I couldn't have learned on my own, but I don't think I would have learned it on my own. You know what I mean? You're saying that because of the inelasticity of supply of tech laborers, workers will be profitable. That's the opposite. For companies, costs would remain high, hurting industry profitability. I don't think that that's what I'm saying. So I'm not trying to make any kind of comment on elasticity of supply and demand. But let's think about that for a little bit. Okay. So I think that this is a situation where both the supply and the demand are very inelastic. So the number of people that you get from that are able to do tech, yeah, very inelastic. There's just only so many of them, and we're doing everything that we can to increase the number of them, and it's not having very much of an effect. Okay, but on the demand side, companies need tech to do anything. And most of them don't have enough tech people, right? So it's just super high demand for it. I tell you, like, especially when you have like the experience under your belt, man, it is insane. It is insane to me how active the companies are. I mean, like, I still get messages every day on LinkedIn, man. I still get stuff every day on LinkedIn. I can't understand order flow for what's the best approach and to create a strategy. Okay, so the first thing that I would say about that is that sometimes we feel like we're not understanding order flow because we're trying to turn order flow into technical analysis. Okay. So when we're talking about order flow, what really is order flow? Order flow is the data. Okay. Order flow is volume data informed by the book. Okay. So order flow is, you can see the bid at each price, how many bids there are at each price, how many offers there are at each price, and then you can see the market orders hitting into those bids and offers. So because you know what the best bid and the best offer is, you can see when volume goes off at that price, you can determine which order was the aggressor. Was it a market order buy or a market order sell? Okay. And that is like the most basic essence of order flow, right? In order for price to move up, the market orders have to overwhelm the offers and push price up, and vice versa for down. Okay. So why does price move? It's because of that interaction of orders, right? Everything else from there is just us trying to understand what actually happened. Okay. What actually happened. And what we can do is, because we understand at that point the structure of the market and we understand what actually happened, there are certain stylized behaviors that happen that we can potentially take advantage of. The most important being the long-term autocorrelation of order flow signs, which is to say that if I take any random moment and I say there was a market buy just then, okay, and then I come back in an hour and I take another random order, it is 0.5% more likely to also be a buy, which seems like a teeny tiny amount, but it's actually like huge when you're talking about an hour. Okay. And why is that? Well, because these large players there's not enough liquidity for these large players to really do the kinds of transactions that they want to do. And so they have to split it up over a long time. And that's why you kind of get these long-term trends, right? So we can look at this behavior, and when we see certain behaviors, that can kind of help us identify potentially the reasons why they're trading out there. And then that could give us a reason to, expect that a trend will continue or not, etc. Right? So that's the essence of how we're using order flow in our trading, right? So don't come in to order flow and say, okay, when I see an iceberg on the bid and the RSI is above this and there's all of these conditions are met and then I buy. Doesn't work like that, right? But what we do is we do this. Is we say, okay, Federal Reserve is taking a lot of money out of the system. We have a 20-year auction today. And it's Wednesday. A lot of people put money to work in the market on a Wednesday. So I anticipate that there could be a trend, and I think that trend is slightly more likely to be sell than it is buy. Okay. So if I see, I come over to this chart here and I say, okay, so what is the order flow that we're seeing right now? Is this order flow in agreement with some sort of a large meta order being executed short? Okay, well, I can see here, price did move down and cumulative delta was moving down too. So in the 30-year, we do seem to have support for that, right? So pretty persistent over this whole long time period of an hour. There's just like a consistent amount of contracts selling. Okay. So maybe potentially we could go into a short. Another thing that I'm going to see is I'm going to see price kind of get stuck like this, right? So the liquidity hole is going to form once it's been there for about 45 minutes. If the meta order is really still there, then I'll probably see another push, right? So I want to get in just before that next push comes, which would potentially be around, it takes about 45 minutes. So like we say that this happened around 7:12. That means that maybe in the next 30 minutes, we could see another move. Maybe in the next 30 minutes, we could see another move. Okay, but it's treasuries. So we also have to look at the other instruments. Are we seeing that in the other instruments? Well, I can see here that the 10-year moved down. But look at the cumulative delta. Look at the market orders versus the sell orders. Well, it's actually kind of technically to the upside. Okay, so the order flow is not what's driving this, right? It's maybe it's moving in correlation with an instrument, or I'm not really seeing the dollar move either. So then I can come back and look at, okay, what's moving it? Well, it's not the 6J, because we had a big sell here in the treasuries and you didn't really get the same kind of accompanying sell in the 6J. Nor did you get the same sort of a thing in GC. Okay, so maybe I can only explain this by saying that they're steepening. But like, look at the, sorry, I'm going to use the pen here again. This right here is the spread. I can see that they're steepening. Okay, so maybe the order flow is buy the 5 and the 10 and sell the 30. Maybe that's what's happening. Maybe that's what's happening. Okay, so is that in line with what I was looking for? No, it's not. The order flows are not in line with the original thesis. So I don't have a trade, right? And that's how you use order flow. Is there a decent R2 for cumulative delta and price movement though? Okay, so price and cumulative delta kind of have a tenuous relationship, right? So if you go in and you say, okay, if cumulative delta moved up, then I want to buy. Or if you say, Cumulative delta moved up, price didn't really move. So I'm going to buy on the anticipation that price will catch up. Okay, not a winning trade. Not a winning trade. Okay. But if you say when cumulative delta and price are correlated, and I can see that there's a decent amount of momentum in the cumulative delta, that's a winning trade. Okay. Why? Because that's a really good sign that there is a persistent meta order out there executing and that you'll see continuation in the trend. Okay. Now, as I kind of poo-pooed that whole trade, we are kind of moving a little bit lower, and I am starting to see selling coming into the treasury. So maybe this is that point where I can jump on board and get a little bit of a winner here. Okay. So I'm a little bit late. I really should have done it at like 27.5. I have obviously can't remember everything that I said. Well, so here's the thing that I think you're going to find is that if you went back and rewatched the stream, that you would be like, oh yeah, I remember him saying that. I remember saying him that, and it would be like, oh okay, maybe I actually did remember everything that I say. The reason that you feel like the way that you do is because really what you're trying to do, your brain is trying to do, is to build a network. Your brain is trying to build a model of how do I use this thing and make decisions based off of it, right? The only way that you can really truly do that is by coming in, watching the flow every day, and making those decisions, and having successes and having failures, and that's how your brain learns. It's like machine learning, right? But what I just did there was I kind of gave you like kind of the key piece of information that everybody gets wrong. Because the key thing that everybody gets wrong is that they think that it's all about some technical pattern, right? And when this technical pattern exists, then I want to come in and take a trade. No. I want to take a trade based off of information that I have, right? And then the flows that I see should be in line with that information that I have. But it's the informational content that's actually the driver of the trade, not the technicals, right? That's the key thing that I'm giving you. Now, you go in, you watch the markets with that information, your brain will figure the rest out. Yeah, what about using cumulative delta as a contrarian indicator? So if I would not advise that. So there are a lot of people that really like the cumulative delta divergence trade. So especially in ES, this happens a lot. Price moves up, cumulative delta moves down, and you go, what's up? And I tell you what, that almost always resolves. It almost always resolves. Every time that I've seen it, eventually one side or the other comes back to in line with the other one. Okay. And there's usually a big move. Okay. So it does signify opportunity, but you cannot predict which side will come. You can't predict whether the cumulative delta will catch up or the price will come down. You just I've not found anything that predicts that. So my approach is that when I see a divergence, I don't want to be in the market. I avoid the divergence like the plague. I want to trade when there are these large institutional players executing huge orders that are going to create persistent order flows that can go for hours, right? And can give me an easy trend. If I'm seeing a divergence between cumulative delta and price, then that's probably not happening at that time. And so there's not any reason for me to trade. Thoughts on using a shocking? No, I don't think that will help. But just, like this is where I think that the stream can be the most useful is you go and like what I would recommend is like go to Zero Hedge, read the Zero Hedge articles, especially when they talk about like Goldman Sachs flow trader John Flood or these, their report on what the major Wall Street analysts are saying, like read all of those, come in on the day and say, okay, what are the things that I think will drive the flows today? Okay. And then watch the flows and say, are the flows in line with my thesis or not? And if not, then what else could be going on? Well, what, and then at the end of the day, you kind of review, okay, this is what I thought, this is what happened, etc., etc. And I'm doing that too, right? We're all kind of doing that and sharing what we get. And you do that day after day after day, and that's how you learn. So you should only I would kind of avoid the FOMC meeting too. The day after the FOMC meeting, yeah, those can be great. The FOMC meeting, the flows are too random to really make a good trade out of, usually. Too much risk involved in those ones. I mean, the thing that I think is funny is that some of the best flows are from like the most mundane things. So like I saw this the other day on the subreddit, and I couldn't help but laugh. So somebody, it was like, NQ hasn't been itself this week. What's going on? And people had all of these kind of weird answers. And then one person said, oh, well, but they're rebalancing the NASDAQ. Okay. So what's happening is those companies that have the largest share of the NASDAQ, people are selling those and redistributing to the smaller companies to account for the rebalancing. And so if you had come in at the beginning of the week and bought those underperformers and sold those outperformers, you would have made a decent profit, right? And that is a flow that's, I think it's mostly done now, but that's a flow that's been going on for days and has made money and has had an extreme impact on the markets. And everybody on the Reddit kind of poo-pooed it. Like, well, who cares? That doesn't matter. Dude, you have like an objective reason where large funds must sell this and buy this. It doesn't get better than that, right? Because ultimately, what are we trying to do? We're trying to predict orders. Try and predict orders. Some of the things that predict orders the best are the dumbest, most mundane things. So much so that like retail traders don't think about them. So are pullbacks during a trend the result of meta orders stopping temporarily? Yes. The way that I would say it is that they pull back on the aggressiveness of their execution. So they could come in and they could say, I want to execute 1,000 lots per minute, right? And they're creating the trend. Once they create the liquidity hole, because what will happen is you will come into an area where the market makers have basically all been filled and there aren't very many people willing to put liquidity up. So you're kind of seeing that right now at 27.5. You see how it goes back and forth. Well, okay, now it just changed, but it went back and forth 2 or 3 times there, and they couldn't get more than 100, 200 either on the bid or on the offer, right? So for some reason, there aren't very many market makers willing to put liquidity up at that price, right? And so what happens there is that kind of constrains price. The market tends to settle where supply and demand are at their minimum. And, there's some liquidity below us. You see there's a big order at 26. There's a big order at 29.5, right? So to get outside of this little range, it would take more volume than usual, right? So you get stuck in this area, right? So when that happens, I can't come in and hit with 1,000 lots anymore, right? I can only take a few hundred at a time. But it stays there for so long that you end up executing more volume there than anywhere else. So yes, what happens is the meta orders, they slow the amount that they take, right? And then what happens is after about 45 minutes is about the amount of time that it takes for the liquidity to recover. Although there's actually some math you can go into that's a lot deeper than that. But in the treasuries, it basically comes out to about 45 minutes. Okay. Then what will happen is there will be enough liquidity has recovered that they will then go and take another section of liquidity. Right. So this is like they take a section of liquidity, kind of comes back, they form this liquidity hole. Yeah. And then they'll do it again. And that's why you get, so really, we say it looks like this, right? That's the classic trend that everybody always looks at, right? But what it really looks like is it's a square root law. So square root law looks like this. And then when they stop executing or they pull back on executing, you will get post meta order impact regime change, which looks like this. And is about 2.5. It's about 2.5 times this in duration. Okay. And then if they still need more, then now the liquidity is recovered, they can do this again. So that's really what it's actually looking like. But when you see it in price, it kind of looks like this, right? That's what's going on. That's what causes that market phenomenon, or at least that's our best theory as to why. And we have a good amount of empirical evidence and modeling that suggests that that's what's really going on. How do you recognize liquidity? Okay, that's a good question, actually. So what you see right here, so for instance, there's 2608, okay, at 112.26, okay. That is what we call resting liquidity, okay. Now, the issue is that market participants kind of have an incentive to hide what they're actually going to do, right? So there is other liquidity that is many times more what the resting liquidity is that will not show up until it executes, essentially, right? Like, look at the way that I trade. I might try and use a bid. I might try and use a limit order, but I'm waiting. I'm sitting here like, oh, okay, I think I can get filled at 27, and then I put the order in, right before I think that it's going to get filled, right? Because I want my order to be out there for as short of a duration as possible, okay? So as things trade, liquidity will kind of reveal itself. And so we call that liquidity the latent liquidity, okay? The latent liquidity, you can't see it on the board, but you can see it after it's been executed, right? So that's why this feature of Jigsaw, where every time that it ticks up and down, I can see how many contracts it took. And then, if it's been a few seconds, it will reset, like it's been more than 2.5 seconds. If we trade back up, that 627 will go back to 0, so that I can see, okay, if we tick up and then we tick back down again, how much did it take, right? That's helping me see the latent liquidity, right? So if we traded back up there and then traded down again, and all of a sudden, instead of 627, it read like 3,000, that to me is like, oh, we just had a huge change in the latent liquidity that suggests that there's some real buy-side liquidity there. That could be something that kind of pushes the flows around and pushes us the other way, right? On the other hand, you could get what we're getting right now, which is they took out 627, and then they took out 27.5 with 627. They took out 27 with 845. Okay, now they're at 26.5, which has been a little bit more stubborn. I bet you that one probably takes over 1,000 to go through. And then you got 26. Okay, but they're falling down on very little, right? So that is like a real trend. That is people, there is selling out there, and the market makers do not want to stand in the way of it. Now, that could be because of a correlation. We are seeing the dollar move up a little bit, and they've kind of been inversely correlated right now. But, right, we're reading the latent liquidity. Okay, so 854, that was actually a little bit less than I expected. So now at 26, I'm going to bet that you need to trade at least 2,000 to clear that. Yeah, I would expect at least 2,000. Okay, but if they do trade that 2,000 and it happens quick, they might just flush through here. You know, like, it wouldn't surprise me to see them take out 2,000 there, 2,000 there, and then, you know, just kind of slip down to 22. Okay, well, they pulled up. There was 968 on the offer, but they didn't hit into the 26. Not quite ready for it yet. Right? It's just us reading the latent liquidity conditions. So now if I'm seeing, you know, them trade that much, like 800s around in here, roundabout. So that time they ticked up, and then they hit back with 745, and look, there was 1987 on the offer. So there was some latent liquidity there on the offer, but they busted through it. Okay. That kind of suggests to me that we are in the area where, you know, they could make another move. Like the liquidity hole has filled, and so we're probably free to move. But there appears to be people on both sides willing to trade this. So it makes it very, very difficult for me to decide, since I don't have a really strong opinion about what the flows are going to be. You know, the current data that I'm getting does not show a clear advantage to one side or the other. So we're still in a position where this could trend further, or it could reverse. Well, so the thing that's weird is that when you look at the 10-year cumulative delta still flat, 5-year down, 30-year not. So the 5-year seems to be the leader here. But we're not getting like super clear agreement between them. I would much prefer, you know, that the flows and the price are all really consistent across the board between the three instruments. Right now, it's still a little bit mixed. Okay. So yeah, that's how you recognize and read the liquidity. Okay. Now, the other thing is again, don't turn it into technical analysis, right? Those are just tea leaves telling us things about the current liquidity conditions. But what is the thing that's actually going to really decide what this does? Well, it's going to be like what those future orders are. Because if there's somebody out there willing to sell 30,000 contracts, like, they're just going to blow through this liquidity that they have below us, right? Now, I'm not saying that I think that there's that out there, or that I have any reason to believe that that's out there. It is in this situation a possibility. It's also in this situation a possibility that either there's a big meta order that needs to be executed long, or the traders themselves just switch to long and we come back up to like that 113 even area. That's a possibility too. And I don't know enough about what the flows are today to really have a good chance of predicting which one it's going to be. So that's why I'm not taking a trade. I am kind of starting to suspect that it will reverse, but I don't know. I took that trade on Sim the other day and it worked okay for a little while, didn't it? I feel like it's a little bit too late for a reversal like that, though. The S&P 500 made another pretty strong gain here, isn't it? It's up another 15 points. So I wonder if we come back over here to the charts. Trading view. To the stock charts. So, okay. So Goldman Sachs had poor earnings, and in the overnight market, they did sell. That's that little jump down right there. But now they are moving up in accordance with the rest of the index. So it appears to me that the flows from the indexes and the things that are causing the buying is overwhelming the selling from people not liking the earnings. So that's interesting. And that just kind of suggests to me that equities are like in the same kind of state. Like you buy the dip basically and over in ES. Okay, are all of the markets the same? So Forex is not. Not that these dynamics wouldn't be at play. So the thing that causes some of these behaviors that we're talking about is because of the order book itself. Like it's a mathematical consequence of using an order book. Okay. In Forex, they're not really using an order book. And in fact, what you're trading is you're just trading against your broker, and there's like the larger interbank trading system that currencies trade off of, right? So, even though there kind of is like flows there in Forex, you can't really see them. All you can see is the money moving and causing the moves in price, right? But anything that uses a limit order book, you will see these behaviors. And so, yes, futures, stocks, cryptocurrencies. And in fact, some of the best research that we have has come from the cryptocurrency market, because over there in the cryptocurrency market, we were able to get data from like back end data from the exchanges to like look at all of the meta orders and you know, verify these behaviors happening across the board. See, so this is a really interesting kind of setup, because again, well, there you go. There it went. Do you see right there at 26, it only took 13.56 to trade it, and now there's like liquidity setting up on the offer? Well, I tried chasing it a little bit, but they didn't fill me. So I tried taking it as she goes, but I wasn't fast enough. Because here I was like, well, I know there's two flows that might potentially be through here. I don't know which one we'll see. Now we're very clearly seeing one. Okay, and we've kind of run into a little bit of buy-side liquidity at 24. Actually, it looks like a big transaction's going on across here, because there's a big bid-side iceberg, and it looks like there's probably a pretty large offer-side iceberg as well. Okay, but we can see now, so this is a good example, though, of like, okay, what did we see in the order flow? Well, They slipped through there really easily, right? Those bids just kind of jumped out of the way. Okay, 6K to take 24. Goes bid again. It's a pretty quick move, wasn't it? The issue, though, is that they've had kind of a hard time staying above 3.78 in yield. So that was a pretty strong flow, but you can already see they got below 3.8 and then the buyers kind of stepped in again. So see what happens. But that was a pretty dramatic drop. Like that was like almost 10K orders just like that. Was a real quick move. Like look at that treasury now. Woo. Just all of a sudden drops at the end. How would you predict that? Well, you'd have to know that the flow was coming to begin with, right? Well, yeah, because you know, if you're the big guy, you want to get that. You need to go and grab that liquidity before somebody else does, right? So there's kind of this kind of interesting game where it's like, okay, I need to wait because the liquidity is not there. But if I wait too long, somebody else might go and get the liquidity, right? But, and this happened a little bit later than it usually does. Okay, but it did still kind of fit in with our usual kind of time parameters, didn't it? Oh man, it's not stopping. It's not stopping at all. See, over here I could do it, but oh, what's this? No. Why is that? S. Some of these are messed up. You should fix that. Don't want to misclick and find myself in a position that I'm not supposed to be in. Okay, another iceberg there, so probably it's best for me to hold off a little bit. So you got to be careful because now we're seeing a lot of volume trade in this area. I don't necessarily want to mess with that. Right. Oh, there it is. Wonder what changed that. S7. Yes. Come on. So the area that I was trying to execute out would have worked. I'd be up 15 by now, but now, when that happened, did we see... Oh, yes, we did. We saw a pretty strong move up in the dollar. Interesting. What amount would you recommend you start out with as a beginner order flow trader? Well, I would recommend that you open up the minimum account size that your broker will allow you, simply so that you can get the data. It's about $30 a month for the CME full order book data, right? And just trade it sim for a couple of months. And yeah, like a couple of months, because it takes time for your brain to even like figure out and realize what it's even looking at to start with, right? figuring out like what are the things that I might know that I can predict flows, and like understanding all of that super technical research jargon and stuff that takes a long time, you know. And it wouldn't surprise me to, you know, that it takes you many years before you feel confident. Okay, but you can come over here and trade these micro treasury yield futures, and you're not taking on very much risk, right? And so for that, you know, if you have about $2,000, right, you spend 500 of it on the platform, and you put 1,500 of it into an account, and you could trade that. And as long as you hold to risk parameters, you should be able to trade that for a really, really long time before you would need to refund the account. Okay, so they did slip a little bit, but they have since then come back to the 24. So on this side on Sim, I could probably get away with a little. Maybe. So let's see here. 1, 2, 3, 4, 5. Okay, so let's say in about 12 minutes. So maybe the bottom of the hour. Kind of sucks when you miss a... I mean, the reality is that I should have been getting short at like 27 if I really wanted to trade that, right? Because if I had really anticipated the flow, and I mean, I think it was on our list, surely that has to do with liquidity coming out of the market and everything, what the Federal Reserve is doing. Well, no, I mean, and it is currencies as well. I don't know. I'm not sure how easily I should have been able to predict that. Let's just say that it was on my radar, but I wasn't sure enough to try and take something. But if I was sure, probably should have been taking it. Well, maybe not even at 27. Probably should have been taking it at like 30, right? Way back here. Did you catch? No, I missed it. I put an order in, but it didn't get filled. I tried to catch it as she goes, and I did it like right as it ticks, and so I ended up with a limit order that didn't get filled. Can it be done as a full-time? So there certainly are some people out there that make money full-time trading. I wouldn't recommend it. So for starters, you know, full-time hours for trading, that's pretty brutal. After 2 or 3 hours, I'm usually spent. Listen, as a retail trader, the income is not very consistent. It really is not. A lot of what you're going to see with retail trading is you kind of do okay most of the year, and then 1 month out of the year, or even maybe 1 day out of the year, you just absolutely kill it, and that makes up for the rest of the year, right? That's kind of hard to do if you're relying on that for your income, right? So I wouldn't recommend it. I think that trading makes a lot more sense as something where you already have a pretty good job and you've already built out a lot of wealth and you have the ability to take on that additional risk, right? Okay, well, they finally filled that bid, but we'll see if this works out. It's a dangerous trade. The amount of risk that I'm putting on for a teeny tiny little win is a little, but I think it's gonna work. Because everything that I'm seeing here does suggest that I'm reading the liquidity correctly and that the hole is around this 24 area. Between 24 and 24.5. I'm pretty sure that the guy from Zero Hedge used to work for JP Morgan because he does not like Goldman. It's just so obvious in everything that he says. Well, the pace of volume has definitely died out, right? All of this volume just came through all at once, and now it's just like I'm seeing a decent amount of dancing in the limit orders, but people aren't all that willing to cross the spread. So that kind of means for what I'm doing here on Sim, for like a market making sort of a thing, that could be a good opportunity for market making. But it's not necessarily a good opportunity for if I want to try and take a swing here with my live account. Look at the size of the 10 a.m. expire. Oh, you're talking about the currencies. Yeah. Could be. You might be right. Might be that this flow waited for the currencies. Yeah. USD JPY number was high. Well, was it? On this move, it looks like the euro was more of a driver than the Japanese yen was, though. I don't think that there was any news. Oh, you know what? I don't think that I'm hearing my news squawk, though. Let me just come in here and double check. Yeah, not really seeing a whole lot in there. Might have been that expiration. Could have been. Second worst quarter for CEO David Solomon for Goldman Sachs. I'm reading the Zero Hedge story on this. Turn on. Oh, what the heck? It's not right. There we go. See, the issue you get with Goldman Sachs is that the trading is such a big part of how they make money. And so they're trying to smooth it over, and then the thing that they did to try and smooth it over ended up being a disaster. Which it wasn't so much necessarily that it was a bad idea as it was bad timing, but still. Let's see here. Goldman Sachs CFO says, we saw some signs of reopening the capital markets, although volumes continue to remain well below medium and long-term averages. Investment banking is performing at its lowest level in almost a decade. There's definitely a pickup in equity capital markets and M&A dialogue. I feel good about where we are on headcount. Okay, well, that's good. In other words, they're not planning on doing more layoffs. Okay, so here in this situation, I could pray for the reversal, but I think if I can get a fill at 25, I'd be super lucky and I should take it. I have Jigsaw and I look at the mini S&P. Why is your price range smaller? So when you're setting up the instrument, there's this option here, tick multiplier. And I use tick multiplier. 4, and then that shows me every full point instead of every quarter point. Okay. I think I would have liked to have done a little bit more than that. Basically, I made 1 tick on each of those contracts. The other thing is I changed the font size of all of my DOMs, right? Well, I would have liked to have gotten filled at 25, but it didn't look like it was going to happen, so I just took the 24 half. Because what I'm thinking, what I'm was trying to do was to demonstrate that we have formed a liquidity hole around 24. There's still a reasonable amount of volatility, and so I can kind of scalp between 23 half and 24 half. And so I did. But that's why I was saying what I'm doing here is a little risky. Because if somebody came in and shot it. So one of the things you got to watch out for, it's probably a little bit too late for this, but you know, somebody coming in and like buying it really aggressively and pushing it back. But I don't think that's going to happen. So I think the play now is the sellers are clearly winning. So, and it has been enough time. You may see a more of a pullback, but I think the play is to be short somewhere above 24 in the hopes that they push another new low later. But I only got 30 more minutes left to my trading session, and it might not happen in that time period. So it's probably not worth it for me to try and do something. I think that I missed my opportunity. If I had caught it, then I probably should be out by now. But if they get into 113, well, if they got to 113, that would be like a huge change in the flows, right? Well, I could do it on Sim. Sure. I'm not going to take it here because I don't have the... I'm not going to watch it after the stream ends, but we can kind of take a shot over here on this one. Oh, I don't know. You know, 113 is kind of been like a kind of a gravity zone. I wouldn't look at 113 as they cross that and then they go way higher. Probably not. Kind of seems like that's a place that they kind of get pinned into. Where do you get the background music? Oh yeah, it's streambeats.com. Yeah, there's a Spotify playlist for it. It's the Streambeats 100 Thieves Hype Tracks list. Okay. Well, if it were to go to new lows before the stream ended, that would be amazing. I don't think that's what's going to happen, but it could happen. I mean, I'm more hopeful than I was 5 minutes, or not even 5 minutes, like 30 seconds ago. Nah. So I really hate to use like price levels, just because, you know, from the perspective of the guy executing the large meta order, they usually don't care so much about those levels. I mean, if you're seeing them execute in the market, then they're getting the prices that they want. You know what I mean? You know, so I don't think about, oh, are we at this level or are we at this level? I only think about, okay, what are the future orders going to be from here? And then what does the liquidity look like from here? So in this situation, you know, I can kind of sort out prices a little bit because I can see that there's very clearly a liquidity hole at 24, right? But so, you know, that's why I can say, oh, I'd want to be short somewhere above 24. Okay, but I can't say anything about 113 even. So far away. Other than that, it would take some it would really take a special order flow to reverse this. Because there's some pretty heavy offers on there. And it was pretty strong selling. If they came in, it would reverse hard. But I don't see it happening. I can't imagine what flow would be out there that would cause that. Yeah, I'm kind of feeling bad about like missing a good trade and not having taken any live trades today. But I really did not have a clear edge, you know? I suspected that it was going to sell, but I didn't have a good enough reason to think that. So I think I'm getting into my own head, and that it really was better that I didn't try and stake out a position. And hopefully for you guys that were new, being able to kind of talk more about the move as it was happening and showing you what you're seeing in the order flow as it was happening was useful and worth the $10 that I didn't take on my live account, right? And y'all already paid me because we already had a donation to the stream, so I appreciate it. Not that I need it, but it was very helpful. Well, that's good. Oh, hey, they took it. Oh, right. Okay. It's been a tough week. It really has. I mean, it's very much a summer week, isn't it? I mean, like through most of June, especially through most of June, we were really spoiled with a lot of activity for a summer month, right? And so probably part of that is, your expectations change and your bearings kind of get all out of whack and you're expecting way more than you should probably get. Because the other thing that I'm kind of looking at here is like, well, I could have taken 378 and I would have made $10, but it would have only have been $10. And there was way more in it. Well, if we had gotten in like way over here, then for sure, but yeah, you never know. But I mean, that just kind of shows you, like the issue is that it doesn't always trend, right? When you get a trend in the treasuries, it just keeps going, right? And when you don't have a trend, it's like hell. Just it goes sideways, and it's just the most frustrating thing, right? I wish that we had known had an edge to do that, because that was a fun trend, I think. But it happens. I am a little concerned though now about what it means for the future. Does this mean that interest rates are set to continue going back? Like maybe we go back to 4% even? Is a possibility? Maybe. July. Well, if July ends up being better than June, it will be because of the last week, right? Surely there will be quite a bit of volatility next week with the Federal Reserve and everything. But Octavius is probably right. August is probably going to be slow. Unless the Federal Reserve really comes in royal markets. Here's what I see happening. How long have I been on that other screen? Here's my prediction. Okay. Federal Reserve comes out. They don't really say a whole lot, just like usual. And don't the same guidance that we have. They do another rate increase. Maybe there's another one coming. We'll see. Okay. And they don't really give us a whole lot. Then what will happen is August will be really tight and quiet because everybody's on vacation. And then sometime mid-September, October, we start turning down again because of interest rates and quantitative tightening and so forth. And when they turn around in the S&P 500, it will be very, very dramatic, probably. That's my primary scenario, like midterm. And I'm basing that off of what I'm seeing in money supply, the lagged effect of interest rates, and overall seasonality. That when we get like those strong down markets, they tend to come through in September and October. I hope the air conditioning isn't eating into my profits. Dude, I closed all of the air vents in the basement and all of the air vents on this floor except for in this room, and then left the ones upstairs open. And the temperature in here is so much better now. Oh, wow. So all of those got filled, huh? Yeah, I didn't notice. So it's time for me to put my limit bids out, huh? So far, market making this range has worked a little bit too well, hasn't it? If we were to say that the last move meta order came in at 8:10, we're 30 minutes out from that. So we could be coming into the next 30 minutes being another time when you could see more meta orders. But the thing, I'm going to be leaving you in 15 minutes. So for you guys that are new, thing that you got to remember is that the European markets close basically at 11:45 Eastern time, so in about 45 minutes. And you tend to see changes in flows around then. There's a very often that after 9 o'clock that you get a move, like a good move that I miss. It happens a lot. And that's people like closing positions and wrangling things around for the European close. So be cognizant of that, the flow changes that might happen after that. And then we have the auction at, what is it? It's 1 o'clock Eastern time? Yep, 1 o'clock Eastern time, we have the 20-year bond auction. So, if I were to continue trading through this, my plan would be, okay, I'm short above 24, and then I would want to be holding that into the auction. Although holding is usually you don't want to be short into the auction because usually the results of the auction is as a help. But, you know, if this is related to the auction, then hopefully you get a little bit of a, what would we say? You get a little bit of a gap down off of the auction. Might be kind of where the opportunity might be. So, I don't know. I don't like holding positions into the auctions. It's a little risky, but that's probably what you'd be doing. I'm too risk avoidant. It's okay. It's summer. I gotta keep reminding myself it's summer. The reason that we're being so risk avoidant is because it's summer. But I want to hit it, you know? I want to show off. That's what it is. Yeah, no, it's probably a good idea that I'm not. You just do something stupid when you try showing off. Oh, now this one up here in the 10 years is a sim trade. So the way you can tell is, number one, I've been putting all of my live trades over here in the micros. So you can see I don't have a position on in the micros. In fact, I should probably turn the account off now. But then the other thing that you can see is at the top of it, if it starts with S, that's sim. Right. If it's a live, it will start with the number. So I just switched it. See, there it is with the number. Now it starts with the 7. That might be too small for you to see on the screen. You might have to like zoom in, but I'm gonna adjust this other contract. Uh-oh, what is this? Oh, yes. No, I already dealt with that. I was thinking about changing my Zero Hedge subscription, but I decided to just wait on that. And I left myself a reminder to check it, but I checked it last night. Had me a little bit scared. I was like, oh no, do I have a meeting at the top of the hour? I really would have liked to have gotten that last contract filled, but well, so the basic subscription that I get for so when I first started, okay, so when Zero Hedge first offered a subscription, I paid for it. And I was like, yeah, this is pretty good, but like they're not really putting out as many articles as I want to get the stuff that I want, you know? And then when I stopped the subscription, then they started doing that stuff. So it was like, okay. And then you know, now the articles that they've been putting out, so like the $30 subscription, really, really good. I think the $30 subscription is really, really good. Okay. Now they have a $100 subscription that apparently gives you like direct access to many of the Wall Street research reports, which is what I'm really interested in. So I really kind of want to do that. But I think that it's, you know, the best thing for me to do would be to pay for a year of it. And I try and keep everything like self-contained, right? Like there's the income for the stream and there's everything else. So I could just pay for the Zero Hedge subscription, but what I want to do is I want to pay for it with the stream. And it seems like it is bringing in consistent enough income that we could afford it. But if I want to pay for a year, you know, that's not as much of a buffer as I would like. So it's kind of like, well, I don't really need it right now. Let's just wait. I should also check here. Where is my September 10th. So maybe September 10th is when I will switch it. Do option flows and gamma in? Yes. Oh yeah. No, I mean spot gamma is a service. Especially if you're trading equity indexes, you're gonna need to be able to have some way of looking at what the options are and what flows that might bring. You don't necessarily have to pay for spot gamma, but like, you know, people are talking about it. There's you do have to watch those things. Yeah. By the way, another little jump there in the dollar off of the euro weakening again, and we're above 100. Can you suggest any resources to study that? Oh, man. Well, okay, so the first thing is you got to understand options in general, okay? Now, options in general, there are so many different places you can learn that stuff from, okay? But you need to be to the point where, you know, what is the curve of buying and selling puts and calls and even some of the combinations and stuff, what those mean should be second nature to you, right? Okay. Then you can get into the gamma, the whole gamma thing, okay? And there's a primer on it. I don't know if you can come Spot Gamma posted a primer. And it was written by Goldman Sachs. And so Goldman Sachs goes through and describes how these funds are using the options and what the stuff in the numbers kind of mean and so forth. Okay. I also have a video about Gamma that gives you the gist of it, right? Because I don't think it's that complicated. Now, you could get into the math and try and do it yourself, but I don't think most retail traders have access to the data that you would really need to be generating the stuff that Spot Gamma has. So essentially what they're doing is they're looking at the overall net positioning and then how much they have to hedge for the gammas. And that will tell you whether they're long or short gamma. And if they are short gamma, then that leads to that situation where when they pass those critical gamma locations, volatility increases, right? Come on, one more. So you see they're doing the, oh, we can only put 240 on the offer. Yeah. That's how I knew it was going to be hard to get filled. They have a video. Oh yeah, they do have a YouTube channel too. Kind of, because Francesco says that, yeah, I went over that. That kind of suggests to me that he wants to do the math stuff. Right. And I don't know if there's, I think that these are all kind of proprietary. I don't know if there's a study or anything out there like that that would show you how to do it. Right. Now you can try and use the volatility range estimates. So we have an indicator, a video and an indicator that actually Gary helped us make that basically uses the opening price for the VIX to estimate the range for the day. That's pretty useful. And kind of is in the similar kind of area. It's kind of toying with me, being like, no, we're not going to give it to you before you go, Seth. Probably what I will do here is leave these on, put a stop order here, and just try to ignore it for after the stream. I need to fix my camera because I don't think the frame rate is correct. It used to be if it is 60. And I need to up the frame rate too. Well, that doesn't look too bad. But I don't know why it went back to the 30p. Oh no, they're right at my average price. Well, I'm not really in a position, even though I only have one contract on, I'm not necessarily in a position to add risk here. If I only want to risk 125. I wonder if it's my... wonder if it's a problem with my cam link. Maybe it's gotten bumped too many times. It just looks choppy to me. We likely get one more hike and pause unless something bad happens. I don't know, man. It's, you know. So I saw this thing, though. I'll leave you with this. So I think it was on the All In podcast. They were saying, do you think that the strength of the is because of or in spite of Joe Biden? Well, like, my knee-jerk reaction is, oh, of course it's in spite of. I mean, the market can do anything regardless of who's in charge. But then I kind of paused and I was like, well, I don't think we actually could really say. So the reality is that this market is really weird and confusing, and I don't think that we really fully understand where the economy is even at. So if we don't even really truly understand where the economy is at, then how can we say why the economy is at that place? You know what I mean? And so that kind of comes down to the same thing for like the interest rate predictions. So for sure, they're going to raise interest rates again next meeting. Okay. But after that kind of seems to be the decision point, the Federal Reserve has been saying 2. Some people have been saying only 1. There's this minority situation where it's like way more than that, you know? How can you say which one it's going to be when we really just don't understand what's going on in the economy in general? You know? I just can't see that far ahead right now. There's too much fog, essentially, right? Too much fog. You know what? I have the opportunity to just scratch this. I'm just going to scratch it instead of trying to let it play out while I'm working, because I know that that's just going to be a distraction. And I got some learnings I'm doing right now, so. We have to separate 2 economies? Well, it's not just that, Gary. It's like when I go and I look at the manufacturing sector, it looks dismal, right? Like all of those kinds of numbers don't look very good. All of those numbers look like we're going into a recession. And then you come back and you look at things like jobs numbers, for instance, right? And it's like, oh no, like the economy's actually, it's going pretty well. Like, oh, we actually are going to get this soft landing, right? Like, it's very contradictory to me. You know, like the way that the market is playing here, kind of says to me that the market thinks one more rate increase and then we'll hold. We'll get a soft landing and then maybe have to start increasing rates again sometime next year. And that we just continue the expansion. Well, I'm not saying that it couldn't happen. It's never happened that way. And all of the data that I'm seeing just kind of really suggests to me that couldn't happen. That we would fall into a downside period in the markets, like we're running into a bear market well before that. And that's why I was saying, like, my primary scenario right now is that August will be really quiet, and then September and October come along, and we get the sell-off then. Because the money's coming out of the market, and what's propping this market up is the all of the shorts covering on the soft landing scenario. And so what I'm thinking might happen is that everybody will end up long exactly at the point at which it appears we realize that the money coming out of the market is a real problem. The quantitative tightening is a real problem for the markets that can prevent them from continuing to move up. That's what I'm thinking. But clearly our ability to predict right now is severely limited. Not that I was ever super great at predicting long term anyways. Things look okay for some and not for others. First quarter of 2024 would be the true test. The Fed dots plots tell the future. Yeah. Well, and that's the other thing is this whole thing that's like, oh, we're gonna increase the dot plots and then we're gonna bring it back a little bit. I'm like, why? I don't understand that. But it's whatever. It's whatever. Okay, I should get going. Good stream today, though, guys. Thanks again. Thanks for the donations and all of the support. I really got to work hard to get that video out this weekend now, right? I should have some free time to be able to finish it. So, yeah. So I will see you guys tomorrow. In the meantime, stay excellent.